Hi, welcome to this complimentary webinar entitled How Professionals Avoided the 2020 Correction. My name is Marshall Beyer, and I'm the Senior Director at Moody's and the Canadian Securities Institute. And I will just take a quick moment to introduce the star of the show, Lloyd Williams. Lloyd is founder of the Mastermind Group, an elite collaboration of investment professionals and traders. He has trained with some of the best professional traders in the world and brings a very unique perspective, having managed retail portfolios and institutional pools of money, as well as being a hedge fund trader. Since retiring quite young from those roles, he has been involved with both coaching and training financial advisors and others throughout North America for over the past 20 years. I know some of you have already benefited from Lloyd's teachings with some of the large financial institutions here in Canada and the United States. CSI was introduced to Lloyd early this year, and we are extremely impressed with Lloyd's unique approach and passionate delivery. By the feedback we received to the last Trade Like a Pro course that he ran, so was the audience. As such, CSI and Moody's will continue to work with Lloyd to support, endorse, and bring his expertise and vast library of content to our constituency. Today's webinar will give you a good preview of his next full-blown Trade Like a Pro course, which is to be delivered starting at the beginning of February. Although I know many of you who are advisors have been shifting your emphasis towards financial planning and wealth management, you shouldn't lose sight of the fact that the investment side is a key component or competency of those roles, and one that surveys show clients still expect the most from you on. Investment management is really the link between your clients' goals and their ability to achieve them. As such, you shouldn't look at this course or the teachings in this course as running against the grain of the shift in your business models, but rather it is very complementary of it. A couple of quick housekeeping notes. Lloyd will speak for around 35 to 40 minutes, after which time he will answer your questions. If you do have questions, just click the Q&A button at the bottom of the screen. You can do it throughout as he's talking, and we'll get to those questions after about 35, 40 minutes. If we don't get to your question during this session, Lloyd will answer all of them in due course. So without any further ado, here is Lloyd.
Thank you, Marshall. It's my pleasure to be here with everybody today. Throughout this webinar, if you have a question, go ahead and click on if you move your cursor to the bottom of your screen, you'll see a little Q&A button that'll show up. If you click on that, it'll allow you just to type in a question. If you would, as you think of the questions during the course of the talk today, go ahead and type them in, and we'll address them at the end as we get together there. And any question that's not answered live today, I'll send out in an email to you. We'll send out all the additional questions we don't get to all of them today in an email this next week. My goal today is to illustrate why building a professional practice that exceeds your client expectations is more important today and easier to accomplish than ever before. Everything is here, and each of you are here for different reasons. Your practice are all different. Your educations are all different. Your backgrounds are all different. Each of you have come as an individual or as a team for different reasons. You may have seen a concept or idea in one of the emails that captured your attention, but your reason is unique to you and to your practice. And we're going to try to make the focus of this talk today cover several levels so we cover everybody wherever they are. What's important here is some of you want to gather more assets and grow your business. Some of you would like to capture more of the opportunities that arise around you. Some of you want to separate yourself from the herd of all the advice that exists out there in the industry. Some of you want to take back control of the investment process in-house. Some of you want to be more proactive in the life of your clients and in their relationships. Some of you want to minimize your asset and revenue loss during corrections, as the endowments and hedge funds have done for decades. And some of you just want to fine-tune an already successful practice that you have and turn it into something that's an autopilot business. So what I like to do is I like to start off with a quick poll. And let me just get the little poll thing up here. And I'm gonna launch the poll. And I'd like to just answer the questions. What is it, what do you want? Select the one that's most true for you, that you most want out of this list here. So we'll take just a couple of seconds here to go ahead and let everybody log in here and check real quick. Go ahead and pick which one's the most important to you of the things we talked about so far today. Okay, we're about 50%. So if you real quick, we'll give you about another 10 seconds to go. 10, 9, 8, 7, 6, 5, 4, 3, 2. We still got some people voting. Anybody else? Final votes. And we'll call it goodness. The same number there. Okay. So we've got a end result here is the number one is to capture more opportunities. The second highest is to gather more assets. And the third highest is to be more proactive in your practice. Now, the surprising thing about all these answers, all these items that you may want, these desires for being here, they're all surprisingly related to the same specific objective, which is to simply be unique, to stand out from the myriad choices that your clients have to make today and choose between. You've got the institutional players coming down by reducing their minimum account size and dipping into the top of your book of business. You got the robos, fintech solutions, and the Robin Hoods out there rising up from the bottom, trying to service more of your clients from an internet standpoint. So practices today are being squeezed in the middle. But you have one advantage over every other option your clients have. And this is a powerful advantage. You have a unique personal relationship with your clients. That relationship gives you a competitive advantage in the marketplace and is the single most important thing to protect in your practice. Now, some of you today are here as solo practitioners. You may have a shared assistant, or you may even have a full assistant, but you have a small practice and you're doing it mostly yourself. Some of you are here with large teams or parts of large operations. We have some money management people here from money management firms and all. And you're part of a bigger organization of people that you're working with. Some of you have successfully maneuvered through the peaks and valleys of the markets as it's moved through its circuitous route that it takes. Others are concerned over the losses your clients may have incurred in the last major correction here, the first quarter of this year. And you're fearful of the next correction when it comes. Professionals have 4 ways in which they stand out, in which they separate themselves from everybody else. Today, we're going to look at all 4 of these ways that the professionals stand out from the herd. First, they build a story that attracts new money. Then they manage proactively their clients' expectations. They create a rule-based practice that allows them to have continuity and consistency and a better decision process. And then they protect their clients' assets, which also in turn protects their revenue. Because I had the unique opportunity to manage institutional pools, retail portfolios, and hedge fund futures, when I talk about professional, or say the word professional management or professionals do this, I'm talking about institutional endowment managers, think university foundation managers, and hedge fund and proprietary trading managers. These are professionals. The latter actually are even more professional because they have almost unconstrained access to what they can do with their money. They have no policy decisions around it. What we're going to discuss is how these two groups have best practices that we can incorporate into the retail portfolio management practice today. We couldn't apply a lot of these 10 years ago, 20 years ago. Today you can. Technology has allowed you entrance into an area that you may not have ever had before. So let's take just a moment and look at each of these four in more detail. First of all, professionals build a story. Now, why is a story important? Well, each of us have a story. The story becomes a mindset. See, professionals understand the importance of story, that as humans, we're driven to tell stories and to hear stories, and we're compelled by a good story. That's why the movie industry and the television industry are so popular. We love good story, and a great movie and a great TV show is great story. But professionals understand that story is important both for their marketing and for their client retention. Now, whether that professional manages an endowment or a hedge fund, they know that changes in the marketplace require an improved, better story. Recent changes in the marketplace have definitely required a better story than we've had in the past. New technology and better tools allow us today to manage retail assets just like an endowment and a hedge fund. Not only do we have better tools, but these better tools and technology have brought on higher speed and greater volume that is dramatically increased over what it was in the past. Professionals know that increase in volatility that came from the new technology with higher volume and higher speed is going to require a better story. Increased volatility and fear, much of which came from the speed and volume that's out there, requires us to spend more time and effort explaining the market to our clients. Professionals know this is an opportunity, not a problem. It's a chance to elaborate the importance of their risk management focus. Again, a better story. Computers like trading ranges. Computers have permanently changed the marketplace in the world markets. Computers love trading ranges because they can make money in both directions over and over and over again as the market goes up and down, up and down. Why is this a concern? Because the retail investor really only makes money when the market goes up. Very few, some firms have no capability of any tool to make money in a declining market except changing to something else. Professionals take advantage of trading ranges and these market declines to increase their profits during periods of consolidation. They're also able to make numerous returns, duplicating returns in the same area as the market goes over the same price points. They get paid multiple times for the market to cover this same territory. And this builds for them a better story. Take a moment this week and ask yourself, what's my story? Write out your story. Ask yourself, how is our process or solution unique in the marketplace? How is our practice adapted to take advantage of the recent changes that have occurred in the marketplace? How are we adopting the new technology into our practice? How does our process better manage the increased volatility that's in the market? And how are we maximizing the influence of computer trading? Now, does your story give you a unique edge in the marketplace, or do you look and sound like others around you? So the important thing is change brings opportunity. And this last decade has seen significant change. And we've seen even significant change in the last 9 months, which for us means significant opportunity to be unique. The first way for a professional to be unique is to build a compelling story that better aligns with the counterintuitive mindset and nature of the markets. This gives them an edge in the marketplace. And in the upcoming Trade Like a Pro course, you will build your own unique story that aligns with your investment process to create an edge in the marketplace. Now, secondly, professionals manage proactively their clients' expectations. Professionals understand that the increasing volatility of the markets both scares and excites their clients. The clients are fearful for possible losses, but they're also excited by the potential for big profits. See, clients have come to believe that all boats float in a rising tide, and everyone looks good because all boats float in a rising tide. But professionals know that anything can happen. You don't have to know what's going to happen to make money, but anything can happen. And eventually, the tide drops. And those who were riding that tide are now have fallen, and sometimes fallen significantly. But they don't have to. And that's why we're here today. They don't have to. Professionals use risk management safety net to avoid major declines in the marketplace. That's why the endowments and the hedge funds have gone for decades, outperforming consistently over and over again the market return by not by making more, but by losing less. The net difference is their avoidance of the declines. That's what the safety net provides them. Now, where do you go when stocks are unfavorable? Do you get defensive? Buy utility stocks or preferreds or a safer industry group, banks, utilities? Or do you go to cash? See, professionals don't do either of those. Endowments and foundations and hedge funds and prop traders avoid the major corrections by managing the expectation before the correction and then adapting the portfolio to align with the structural changes that occurred in the marketplace itself. This is not a stronger defense, but a stronger offense. Take some time this week to look back at the major corrections during your career. Calculate how much larger your assets under management would be and your revenue would be today if those losses, or some portion of those losses, 50%, 65%, 75%, 80% of those losses had been avoided. How much more would you have? It's a shocking figure. And when you compound it over some of your 20, 25, 30-year careers, it's a stupendous number. It's just scary how much more is out there that's been set aside. And that's why the hedge funds and endowments have a substantially greater pool and a greater attraction factor, is they've avoided those major corrections and been able to compound that and maintain the revenue. Now, ask yourself, do you have that safety net or plan in place to do something different when the next correction occurs? Because there will be another next correction and another one after that and another one after that. How would your clients respond if you avoided the next correction by 60, 70, 80, 90%? It'd be a celebration. The endowments and hedge funds have consistently outperformed the markets and avoided losses by incorporating better risk management model and managing the expectation. And so can you. Professionals know the best time to prepare for a correction is before it occurs. This is why risk management is put first and is superior to profit taking and performance. Risk management is not put in place during the correction. Risk management is put in place during the clear light of day before the correction. See, the second way for professionals to be unique in the marketplace is to manage the client's expectation. and then to create a risk-based safety net to cradle their client's portfolio. Now, during the Trade Like a Pro course, you're going to learn to use risk management the same way the professionals do. And the structure of the marketplace, just like the endowments and hedge funds do, to protect your client's assets and your revenue stream. And in the process, you'll be better equipped to manage your client's expectations. The third way that professionals set themselves apart is they create a rule-based practice. Not just a rule-based process, but a rule-based practice. This is central to their continuity, their consistency, and their success. By making it something that's rule-based, both their process and their practice are repeatable. And continuity and consistency get built, and with that, the success that they have is repeatable over and over and over again. The process problem too many people have in the retail side is they don't have a rule-based practice. Therefore, when they have a great success, they can't duplicate the next year because they're not doing the same thing the next year they did the previous year. They're not maintaining that continuity and consistency. When you look at the ideal process, the Trade Like a Pro, to trade like a pro, you must trade based on a set of rules. These baseline rules create the structure that helps you avoid cognitive bias, where you look in one direction. Because, as the professionals know, anything can happen. A bullish or bearish bias blinds us to the possibilities. We hope and look for evidence that confirms the one thing we'd like to have happen. And we miss all the other evidence or everything else that's out there that's saying something else is going on. Now, the structure for rules is probability-based. All rule-based systems that have successful track records are ones that are based upon probability. And they lead the professional to a series of hypotheticals so that the trader can act now. See, this entire process is done by asking and answering just a few simple questions. Repeating that over and over again. A few of the tools used by professionals are context type questions. Others are binary questions. And then the other is the whole aspect of cognitive dissonance. Now let's take a moment and look at these three a little closer. Context questions. These answer a better understanding of what's going on around you. So the answers to these questions help the professional better understand the sort of the landscape of where the market is right now, where it's trading within. There's the question, what has the market done, which helps understand the historical context of what happened in the past. What's the market trying to do helps the current context and understand that current context within the market cycle that is repeated on a regular basis throughout the market as it goes through time. So knowing where you are from a historical and a context, you can now step back and ask the third, how good a job is the market doing? Where's the strength in the market? So within this context, where's the buying and selling pressure so we can have evidence of which side is stronger? Now, so context questions give us the bigger picture and then help us narrow it down to its real-time moment. Binary questions help the professional avoid mistakes. By asking, is the market trending or in trade range? Is it up or down? Is it strong or weak, tight or broad, support or resistance? The professionals ask binary questions to clarify what actually is occurring. But more importantly, what also is not occurring. That's just as important. Binary questions rely on current information and avoid the misinformation from a lagging indicator. Now, this increases the professional's precision in their decision-making process And it also helps them better understand and avoid the mistakes that can occur by not asking binary questions. After answering these questions, the professional must do the impossible. They must now maintain the mental state of cognitive dissonance, which is the ability for a professional to hold two contradictory thoughts at the same time. Because anything can happen, the next bar can be bullish or bearish. Now, professionals trading and the way they do it is not about prediction. It's not about timing. This has nothing to do, they're never trying to time anything. They're never trying to predict. They don't even have expectations. It's based upon probabilities which between several different hypotheticals, any one of which may trigger an action. Cognitive dissonance avoids and removes emotion and allows the professional to act objectively, not based upon intuition. See, a rule-based process incorporating context questions and binary questions and cognitive dissonance leads the professional to the creation of hypotheticals, that most important component of professional management. See, hypotheticals allow the professional to prepare for multiple possible outcomes. If anything can happen, we need to look at those anything choices, options. Not be biased and I only want this to happen. But if this over here happens, and I'm only prepared for this, I can't take advantage of this. So what if questions, what if the market goes up? What if the market goes down? What if the market goes sideways? These remove the cognitive bias in the process. So when a hypothetical is triggered, it's acted upon immediately. Like the pilot in the storm, flying the airplane through the whiteout. They can't see anything, have no idea what's going on. They are forced to follow their instruments. Professionals know that anything can happen. And hypotheticals allow them to act without hesitation when that anything occurs. So the third way for professionals to be unique is to create a rule-based practice and ask the right questions. And in Trade Like a Pro, you're going to learn to master the trade process that professionals use, and to better prepare yourself to benefit from the uncertainties of the market by being prepared for anything to happen. Lastly, professionals protect their clients' assets and their revenue. Professionals know that the markets are counterintuitive by nature, but we as humans, we like to have things based upon intuition and emotion. We make a lot of our decisions that way. Matter of fact, how many times you've made a decision, your decision got delayed and it ended up being to the detriment of your performance. So instead of acting, your intuition said, no. Now all your tools said, your instruments said, act, but your intuition and emotion said, no, maybe not right now. One important counterintuitive shift that professionals make versus retail marketplace is their understanding of profits. Professionals know that profits are like smoke. Here today, gone tomorrow. Because profits disappear. It took 16 months in 2019 and 2020 for the market to reach its high. And it only took 4 weeks to remove all the profits of that entire period. Professionals know that profits should be taken based upon structure and not based upon price. You don't say, I bought it for 25, I want to sell it at 40. Structure may say that 35 is where you need to be getting out of this at. it's not going to get to 40. Therefore, professionals take profits often because profits disappear. Now, this chart we have seen, everybody shows it. This is the chart that's always shown to everybody. And it's to prove that buy and hold strategy is the best strategy out there. And the argument goes, you will underperform if you miss the 25 best days of the market. If you miss the 25 best days, you get the red line. If you don't, you get the black line. There's a 4 times greater return in the two. Now, therefore, they conclude buy and hold works. Now, the underperformance is true, but it's not the whole truth. Buy and hold is not just a logical conclusion of that. This argument is never made by a professional because of the importance professionals place upon risk. See, professionals measure risk as standard deviation. The negative cost side of the risk we call loss. And the positive part of standard deviation, the opportunity side, we call profit. Now, a buy and hold philosophy guarantees the investor gets 100% of all the profits and 100% of all the losses. So this is the chart we never see. This chart illustrates why buy and hold philosophy is flawed. It illustrates that missing the 25 worst days substantially outperforms. Twice as good as the previous chart. And not only is it more than twice as valuable as not missing the best days, this works because professionals know that losses have a greater negative impact than profits have a positive benefit. They also understand that losses are permanent. Now, losses wipe out the profits. This is why professionals often call this whole philosophy buy and hope. Charles Dow in the 1890s founded the Wall Street Journal, the Dow Jones Industrial Average, and he wrote a series of articles in the 1890s for the Wall Street Journal as editorials that established the fundamentals of professional trading that are still followed to this day by professional managers. He showed very clearly that 80% of all performance comes from being in the right asset class, not the right stock. So endowments and hedge funds use asset rotation strategy that protects their clients' assets. This way they move from strength to strength, from offense to offense, not from offense to defense. Whereas most advisors manage retail portfolios using sort of a fixed asset allocation. This places the portfolio on the roller coaster of profit and loss and profit and loss. So the fourth way for professionals to be unique is to protect their clients' assets and their own recurring revenue. In the upcoming Trade Like a Pro, we will learn to protect your clients' assets and preserve your revenue stream by using the exact same tools that professional endowment and hedge funds managers use, many of which are available today on the market, on the internet, for either free or very inexpensive. Imagine if you could raise more assets in a single 12-month year than you have in the past decade. Imagine if you could have time to focus on more important opportunities before you that rise up. Imagine if you had a unique story that attracted prospects and assets to you. They're knocking on your door rather than you knocking on their door. Imagine if you could be proactive in solving client problems, creating a wow experience that separated you from everybody else around you. And imagine if you could avoid the next market decline and the one after that, like the professionals do. See? And imagine if you could add to your current successful practice the best tools of the endowments and hedge funds. See, you can have all of these, not just one of them, all of this. That whole poll, all of those items on the poll can be had once you understand what's important. Today, we're just scratching the tip of the iceberg of the content that's included in Trade Like a Pro, which is open now, by the way. Trade Like a Pro is not about trading. It's not just about trading. If you've read the testimonies, you've realized that previous participants, it's so much more. See, the important word in the title, Trade Like a Pro, is not trading or trade. It's being professional. See, a professional practice is very different from a retail practice in mindset, in systems and processes, in its rule-based nature, in its focus on the risk over superseding everything. This is why everyone will need to either become professional or risks surviving what's coming. The move from being retail in mindset and practice to professional is going to be the most important thing to avoid being squeezed by the top or pushed out by the bottom. And all you have is this little middle. And you can. Now, the Trade Like a Pro course focuses on deliverables that can turn concepts and principles into tangibles that add value to your business immediately. The course focuses on the threats to your business from above and below by the hedge funds and the Robin Hoods of the world to within and without from the inefficiencies in your practice and the changes in the marketplace itself. The course focuses on a professional mindset and a professional business practices that better prepare you to adapt to the uncertainties of the future. The course, we're going to give you the professional tools to help you better understand and manage and exceed your clients' expectations. And the course will help you apply the endowment investment tool model and the tools of the hedge funds and proprietary firms to your retail clients at all levels, not just at only the top, but at all levels. The technology today gives us huge advantages, no matter what type of practice you're running. See, the necessity to future ready your business and how to future-proof your practice in order to create exponential results is your biggest concern going forward, because the markets, the clients themselves are moving so quickly into the future, headlong. And if you don't adapt and add the new tools to what you're already doing, you're going to find yourself left behind the herd. And you don't want to be behind the herd, you want to be leading it. Now, Trade Like a Pro is 15 hours of live instruction over 5 weeks. Every Monday, we'll have a 2-hour live training session that'll prepare you for that week's materials. Every week, we'll roll out a series of the modules for that week. Thursday of that week, we'll have a 1-hour live Q&A session to answer all your questions as we go through the week. In addition to this, there are 16 modules of online training on teachable.com that systematically walk you through all the concepts and practices. Now, all the live instruction, all those live Q&As are all recorded, just like today's call, so that you can, if you miss it or if you have to cut out some part way through, you can go back and play. You will also have the ability to have access to the content for 6 months while you're going through the course. You can review it, you can share this with your team, and all of you can sort of walk through the same process together. Now, you'll have tangible deliverables. They're going to give you the ability to incorporate the concepts into your practice immediately. I believe in tangibles. My whole reputation as a trainer and teacher has been that I deliver immediately accessible and implementable deliverables. You have a workbook that you download each week for that week's worth of work that walks you through the course. And in the end of the 5 weeks, you have a 400+ page reference book that you can now reference back going forward for the rest of your career. During the course, you have 24/7 access to me and the team to get your questions answered. Any questions I don't answer during a live session, I'll send out an email to everybody so everybody can have it. So you'll have all the answers to all the questions. We have a huge FAQ from the previous course that you can go through now and look at it and very clearly see, get most of your questions answered there also. If you've read any of the testimonials from the previous clients, you've seen that the course exceeded their expectation. We're so confident in the value of the content and you're going to be satisfied with it. We have a 100% satisfaction guarantee. The course is endorsed by the Canadian Securities Institute and by Moody's Analytics. And IROC has authorized 20 CE credits for everyone who completes the course. And at the end of the course, you get a 100% completion. There's a quiz you have to take that CSI set up for you to go through. Once you complete that quiz and you've passed you've gone through all the modules, you then receive your 20 hours of CE credits from IROC. Now, you have not just the 5 weeks of the course, you've got 6 months to finish the whole thing to go through and get your 20 hours of CE credits. So you don't have to rush through. If you're one who needs to take time and look at things over again, you can do it over. You and the team will have access to it for the whole 6 months. Now, the following are statements from previous alumni of the Trade Like a Pro course. And like you, they reflect a variety of needs and desired outcomes. If you want to gather more assets or capture more opportunities or separate yourself from the herd or take back your control of your process or be more proactive in the life of your clients or maximize your clients' profits by minimizing their losses and maintaining your revenue stream. Or if you just want to fine-tune your practice with better professional tools, this course is for you. Now, when you register, you have immediate access to Module 0, which is the pre-course prep module. And there's a lot of pre-course prep work, so you should register as early as possible. It's already online. Those who have already registered are already going through Module 0. And you have at that point there, you have access to us. So if you have any questions, we help through the process. Now, if you want to register today, you can go to the link here, and there's a discount for CSI members, and the designation holders have an additional discount. I recommend, as I said earlier, that you register early as possible so that you can do all the pre-prep coursework before the course starts. Now, I'd like to take the rest of our time. We got about 15 minutes or so here. And I'd like to take the rest of our time to do Q&A. So if you haven't added any questions to the Q&A box yet, go ahead and click on that little button that says Q&A, and we'll and go ahead and type in your question there. Marshall from CSI is going to select some of the questions now for us to do a live Q&A with. All the questions will be answered. Let me just tell you that up front. If we don't get to your question today during the live session, we will definitely get to it during the, I'll do it this next week. I'll go through it, and we will actually take that and put it out to you as an email, so you'll have that access to it that way. So I promise you, you'll get your questions answered. We're not going to leave anybody without the questions being answered. So please feel comfortable that it will be, you will get the question going forward. So let's, I think I've undone all the, we're back to screen mode, gallery view, so you should see me. If there, Marshall, you want to
Sure.
see if there's any questions there? Go ahead and let's start.
Sure. So Lloyd, the first question has to do with protecting your client assets. And the question is, do you need an options license? Do you need to be able to use options to employ protection strategies?
No, you do not. Some people have options license, and that's fine. There's things you can do in additional tools. That is one of the ways you can help your portfolio, but it's not necessary, and most people don't use them. As a matter of fact, the mastermind group has not had any option purchases done and avoided 91% of the correction in the first quarter without any options. So it's not, you don't have to have options to protect the clients from losses.
Okay.
If you have an options license, that will show you, we're going to talk about options in there and show you where they can be used for those. We're going to take each module, every lesson will be taught on multiple levels. For those of you who have a huge practice, all the way down to the person that's managing just the family portfolio or the, retail clients with no assistance and no help. So we'll talk in every module. We'll talk in all these different levels, so you have different ways to see it. Same thing with the online course. We go over different levels and different ways of applying the concepts according to what size you are, and we show you up front how the levels are laid out.
Okay, thank you. The next question asks you when you think the next stock market crash will take place, but as you've already talked about, we can't really predict the future, but I will broaden the question out. We've seen 3 severe market crashes this millennium, I guess, in 2000, 2008, and just earlier this year. What has changed in the market? You mentioned that the market dynamics have changed. What exactly has changed that has kind of led to this tremendous increase in volatility and market meltdowns as we've seen?
Thank you. The biggest part is the big change. We talked about this in module 1. One of the biggest changes is the actual introduction of computer trading into the marketplace. Because with computers, prior to 2000, there were no computers involved in trading. It was all humans, and all humans have a buy-side bias. So a client human calls a broker human to buy 100 shares of XYZ, and the broker calls a trader human, says buy 100 shares of XYZ. Across the country, another client human calls a broker human, who calls a trader human and says sell 100 shares of XYZ. Now, all 6 of those and all the others involved are all human, and they all have a natural, native, inherent in their system DNA buy-side bias. That's why we saw 65% of all bars in the marketplace were up bars. And the market had these huge long channels we used to run in. If you notice that chart I showed you earlier in the presentation of the trading range, computers like trading ranges, from 2015 on, most of the market was not channels, up or down. Where it used to, you had 65% of the time, you could be right just buying and holding anything because 65% of the time was a buy-side bias. Today, that 65% is now a trading range, and it's only 30% of the time that you're right and the market's going up. So it was easy for advisors to make money from the beginning of retail advisory work all the way up to 2000. It was easy. You just rode the tide. 65% of the time it was going up. That's not the case. Now it's flipped. We call it the 65-70 shift. Now more than 70% of the time you're wrong, because 60% of the time the market's sitting over there in a trading range and going sideways, and 10% of the time it's going down. 30% of the time it's going up. So now instead of being right 65% of the time, you're wrong 70% of the time. We're not making money. And that's what's made these last years more difficult for you than the past. Professionals understood this and adapted with it and have benefited from it. And that's where the volatility is coming from, because the volume they're trading is so high. When you pull that volume out of the order flow book, you create volatility. That's what volatility and risk are different things. We're going to talk about that. Volatility is the order flow book and the liquidity within the order flow book. If there's no standing orders, a market order comes in, sweeps the book. That's volatility. That's not risk. Risk is something different. And so some of this, we're going to teach you some language that you can use with your clients to give them better understanding and better comfort. The difference between a professional and retail is the professional, when they sit down with a client and talk them through, the client has a great sense that they really understand that not only does the expert understand what's going on, but they now understand what the expert understands. It's like the difference between talking to your general practitioner and the surgeon who's actually going to do the heart surgery. The GP gives you sort of a generic version. The surgeon gives you the real details, and you feel comfortable with them. Next, Mark.
Okay, thanks. I am a disciple of Fama and French, and my understanding of their research shows that you cannot predict the short-term direction of the markets. You get it right 50% of the time and wrong 50% of the time. How does your course align or disagree with them?
I agree 100%. I said earlier, you cannot predict the market. We're not predicting the market at all. That you can't do it. If anybody that says they can is just lying to you, and they may be good at it for a short period of time, but it will blow up in their face. Professionals do not predict the market. Newsletter writers do, and all these guys that sell trading programs out to retail people to get over here and say, hey, here's my trading this thing and trade that way there. But that's not what we're doing here. I'm just showing you what professionals do. This is what a hedge fund does, how they manage money. This is how a endowment fund manages money. And they use a very specific process. We're going the master trade process. This is the way they place a trade. And it's not about predicting. There's no predicting. When the trade is triggered, they act. The hypotheticals allow them now to be prepared for anything to happen. They don't care if it's 50% on this side or 50% on that side. They don't care if it goes up, down, or sideways. They can make money in all three directions. And that's the difference between professionals and retail. And the advantage now is the tools are available, the investment vehicles are available that weren't before, and the pricing has come down so much that it's easy for you for clients to afford it. There are things that we're going to show you that you couldn't afford to do because this is the cost of entry was just too much, and that's no longer there. It's no longer a barrier. So yeah, I agree 100%. I mean, we just don't predict. Anybody that calls and say, well, what do you think about the market? What's the market going to do? I don't know what the market's going to do. I know what the hypotheticals can be. I know what it can do. Then we'll wait and see which one triggers. And the difference is in what professionals do is they understand what the triggers are, and retail doesn't. That was the biggest difference that I learned.
Okay, thanks. Lloyd, there's a few questions about like who should attend this seminar. Should it be a discretionary managers, retail advisors, investors, mutual fund representatives? Who's the target audience for this course?
Good question. The best way to manage money in the world today is to be independent and discretionary and have all be under no regulatory body, like be your own hedge fund. There may be some of you in the audience that way, but no, that's not most of you. That's the best. Everything else is something less than that. But if you're managing any money in any way for yourself, for your family, for your clients, a mutual fund, a hedge fund, whatever it is, however you're managing, that's the tools we're going to show you. You're not going to be able to find unless you can go have somebody hire you at one of the big institutional endowments, or unless you can go train with Goldman Sachs. You're not going to find this because they don't write books about what they do. This is where you've got it. Now, the advantage here is that even if you're not managing a portfolio, you just want to understand better the risk that your portfolios are going through, where they are. You're going to find value, because our goal here is to help you not just learn the trading side, but the practice that's around it. Learning how to trade solution. You can trade great and have a terrible practice surrounding it and still not grow your assets or maintain your assets, because execution inside that practice is going to require whether that trading process that you have can be executed properly. I've known a lot of people that had a great process but couldn't execute on it because the practice had problems. That's why I said up front, this is the most important word in this title is not the word trading or trade, it's the word pro. You've got to build the professional practice that surrounds your investment process. That's what we're going. That's why we're going to talk about the whole thing, not just this one. This is not how to learn a new entry on a buy and sell on an option or stock or something. That's in there. It's only a component part of a bigger pie, which is to build the practice that's sustainable long term with a process that's sustainable that allows you to benefit in whatever direction the market goes. And that's what we're here for.
Right. Just a quick follow-up. Is there a course agenda that that our listeners can see?
Yes, on the actual page that you went, if you go to if you click on the button that says register for the course, if you go there, there's a page that has more testimonials, and it also has the actual curriculum, and you can actually look there and download the curriculum itself, so you can see the curriculum. There's the outline of all the 5 weeks is there, everything else. So if you that email that you clicked on, that you registered up here, there's a link in there that says I'd like to register. You don't have to, you can just go and see it, but I want more information. I think it's called a more information button, more information about the course. Just click on that button. There's a whole website page set up that explains the course in more detail for you with more information there, and that'll give you all the answers. And
okay.
If you have questions, just drop us an email and we'll answer the rest of your questions.
Right. Has current unprecedented investment environment, i.e. ultra low rates, higher uncertainty, prompted you to update the course materials?
Yes. This is the 11th cohort of the course. And like I said, the workbook's now 400 plus pages. It's now 40 hours of instruction. Originally, this was a 2-day workshop that you got a workbook and that's it. We had 2 days, 8 hours a day, 16 hours later. It went from there to a 39-hour workshop over 3 days. And then it went to a long weekend thing. And it's now what it is today. It's a 40 hours, it's a long course. So we keep adding it as it's kind of, we've added content. This course was just done last fall in cohort 10. Cohort 11's already got new content in it. There's already another 10-15% new content in just the changes that have occurred here. The course, those who are in like the mastermind group have access to the course forever. And so they just, every new iteration, they just keep getting access to it. So I keep adapting the course. It's been a decade, it's been in or more, it's been in iteration. So we just keep changing it, keep making it better.
Okay. There's a question about what you think the best asset class is at these times, but maybe I'll broaden it out. You mentioned the importance of asset allocation. Can you also describe the importance of asset rotation in this model?
Sure. If you take right now, if you look at the relative strength of the markets, the equity asset class as a whole is the strongest asset class. Currency right now is the second strongest asset class, predominantly in China and Korea. The third asset class would be the commodity asset class, led by steel and timber, and that kind of stuff there. And there's sectors in there. There's certain sectors that are powerful there too. And then the last is actually the fixed income. The bond markets are the lowest. Matter of fact, there's nothing strong about the bond markets right now. They're almost all in the red. Everything else. So that's the ratio. So right now, the strongest asset class will be equities, and in that order I just gave. Now, asset allocation is some kind of fixed mix where you say, okay, I'm going to have 30% in this and 20% over here and 20% over here, and another change over here. Now I have my portfolio, and that mix sort of stays that way. And most retail portfolios are pretty fixed, and even they have a little rotation. Most of it's pretty fixed standard. Endowments don't do that. Endowments stay in the strongest asset class with the predominant amount of their money. They may spread it among all 4 asset classes, but they have a concentration in equities right now. They have another concentration in currencies, and then it would have less so in commodities and less even so in fixed income. And if down the road that changed and all of a sudden fixed income became the strongest asset class, they would rotate out of one into the other. And that's one of the ways that the endowments have substantially for the last 20, 30 years outperformed. They have never had a losing year. Even 2008, they didn't have a losing year as long as they stayed within their parameters. The endowments that lost money in 2008 are the ones who added the one thing that you can't add to a portfolio that's an asset rotation portfolio. Asset rotation by its very nature requires that the investment vehicle be liquid. So the people that got clobbered in 2000 were all the people that put their endowment money into private equity and couldn't get out of it. They then put a policy said, no, we're not going to buy anything that's illiquid. Well, timeline, by the time we got to 2007, they'd forgotten all that and they put private equity back in again. In 2008 came along and they lost money again in the private equity side. Now they put another policy, we're not going to buy any more things not liquid. Now we've come to 2019, 2020, and what do you hear? Endowments have, hedge funds now have huge positions in private equity. Might be an indication that maybe it's something down the pike here. They also have a huge concentration in tech stocks, just like they did in 2000. So understand there's a lot of stuff in play right now that makes a negative side that the avoidance of a correction would be important to you. We don't have to predict it. We just have to be able to act when it happens. And knowing what to do to protect your assets, whether you're managing mutual funds, whether you're managing ETFs, whether you're managing a stock portfolio, or whether you're managing options or futures, whatever it is, the process we show is agnostic to your technology that you control, whether you're a Mac or Apple or use this program or that program. Whatever your investment strategy is, whether you're a value investor, a growth investor, whether you do a dividend discount model or you do a growth model, doesn't make any difference. It doesn't make any difference what time you want to trade, you trade with on, whether you look at it every day, you look at it once a week, you look at it once a month or once a quarter, or what instrument you invest in mutual funds or in ETFs or stuff. The process is independent and agnostic to all of that. It works in all those models because it's just an overlay on what you're already doing. We're not going to try to change you from being a growth investor to being a value investor, or from being a value investor to being a growth. We're not going to do that. We're not going to argue with it. If that's what you feel, that's great. I'm how happy for you. We're just going to show you an overlay of putting on top of what you're already doing, the tools that you don't currently have, the processes you don't currently have that will move you from being a retail style management practice to a professional style management practice. Any one thing you do that helps you avoid some simple part of the market correction in the future will pay for this course 1,000 million times over.
Lloyd,
practice lost a lot of money in the first quarter. You want to avoid that going forward in the next quarter whenever it happens in the future.
Okay, Lloyd, maybe just one more question because we're a few minutes
more,
after, but Philip asks, can each member of my team access the course under my registration, or does each individual have to register and pay the fees?
Anybody on your team, I consider your team the profit center that your firm has under a broker number or whatever number it is. So it's team. It's not you and the guy next door in another office, but you have to have a single unit. But the people on your team have access to the product during that. Now, if they want to have their IROC credits, they've got to sign up individually.
Right.
But if they want to not have the IROC and they're part of your team, and yes, they can log in as your team, listen to the videos when the video links come, you can share with them, but you can only share within your team. If you share it outside that, we're going to get really upset with you. But outside that, yes, I believe in your team as a unit. Now, if there's two partners, we've had a lot of partnerships that were in the last cohort. Both of them wanted the credits. Both of them signed up. You've got discounts from your membership and from your things. So you've got to just understand, guys, this course is prior to the last two cohorts, this course was only accessible for $5,000 to $8,000. And you spent 2 to 3 days of your life through the process. You had no access to it after that. Whatever notes you took is all you had. You guys have 6 months of access. You've got 40 hours of live instruction spread out over 5 weeks. You've got me as your personal coach during the actual 5 weeks. This is the least expensive way you're ever going to get this information. And the price is only going to keep going up every cohort. We bump the price cohort, we'll bump it again the next cohort. It's just going to keep going up. So if you want to learn the tools, access it earlier rather than later. That's our time. What I'm going to do is Marshall's got, Deborah will pull up all the questions. Any question you asked that was not asked, give me a few days to go through them. I'll answer them all out and put them all in, and we'll send them in an email to you. Everybody, so everybody was registered for the call. We'll get the video link, and you'll get the Q&A, additional Q&As answered. And if you have more questions, please just send a note to courses@lloydwilliamsinc.com. That's courses@lloydwilliams, not lloydwilliams.co, sorry. lloydwilliams.co, not com, not com.co. So courses@lloydwilliams.co, and we make certain you get an answer. And if it's an answer I think that everybody can use, we'll put it into the next email broadcast so everybody knows what they're. We have a huge FAQ. You're welcome to look at it on the actual page. There's an FAQ on there. You can look at it. Also has probably a lot of your questions already answered on there. So I hope everybody was helpful today. We will be doing another webinar down the road, but look forward to having you involved, and please register. There's a lot of material to go through. There's books I recommend you read before the course. There's a number of assessments you're going to go through with you, and you can do run your team members through this assessments and everything else. This prep up, there's some questions and homework you need to do before the course. So the sooner you register, the more you've got access to the actual content, and can start applying it to your practice and everything else, and getting ready. Because you really want to be able to hit the ground running on module 1 and go, because we're going to be issuing out 3 to 4 modules every week as you go through the 5 weeks to get you through everything. So everybody, I hope you had a great day today, and we look forward to seeing you in the course in February. And I'll try to answer all your questions, and we'll go back from there. Everybody have a great day. Thank you again, Marshall,
Great.
for your time
Thanks,
today.
Lloyd.
And
Thanks,
we'll
Lloyd.
see everybody later. Thank you.
Okay. Bye-bye.